I'm going to be brutally honest with you. For the first 3 years of my trading journey, I lost money consistently. Not because I was stupid, not because I didn't work hard, but because I was doing what everyone else does when they start trading. I was chasing patterns on charts, jumping into trades based on what some guru said on Twitter, and thinking that the next indicator would be the magic formula. 20,000 hours later, sitting here with actual profits in my account and a system that works, I realize the whole game is nothing like what they tell you. The market doesn't care about your opinions, your hopes, or your financial situation. It's a machine that transfers money from the impatient to the patient, from the emotional to the disciplined, and from the complicated to the simple. What I'm about to share with you isn't theory from some textbook. This is what actually works when you're staring at red numbers in your account at 2 in the morning, questioning every decision you've ever made. Let me start with the most painful lesson I learned. Trading is not about being right. This might sound backwards, but hear me out. When I started, I wanted to predict every market move. I wanted to be the person who called the top or the bottom. I spent months studying every technical indicator, every chart pattern, every piece of economic data. I thought if I could just learn enough, I could predict the market consistently. That's not how this works. The best traders I know are wrong almost half the time. What makes them profitable isn't their accuracy. It's their risk management. They lose small and win big. When they're wrong, they get out quickly with minimal damage. When they're right, they let their winners run. This single shift in thinking took me years to understand and cost me thousands of dollars to learn. Here's something nobody talks about when they're selling you courses. The market has no memory and no emotion. It doesn't know you exist. It doesn't care that you need to make money this month to pay your rent. It doesn't care that you just lost on your last 5 trades and you're desperate for a win. The market is simply a collection of millions of participants making decisions based on their own information and psychology. When you enter a trade thinking you need this one to work, you've already lost. The desperation changes how you execute. You hold losing trades too long hoping they'll turn around. You exit winning trades too early because you're scared of giving back profits. The market rewards those who treat it like a business with rules and systems, not like a slot machine where you're hoping for the next big payout. Position sizing changed everything for me. This is the concept that separates professional traders from gamblers. Most people ask what stock to buy or what setup to trade. That's the wrong question. The right question is how much to risk on each trade. I follow a simple rule now. I never risk more than 1% of my account on any single trade. If my account is $10,000, I'm risking $100 per trade maximum. This means if I have 10 losing trades in a row, which happens more often than you'd think, I'm only down 10%. I can recover from that. When I was starting out, I would risk 5 or 10% per trade because I was so confident in my analysis. A few bad trades, and suddenly I was down 40%, desperately trying to make it back. That desperation led to even worse decisions. Small position sizes feel boring when you start. You want the big wins, the account doubles, the stories you can tell. But small position sizes keep you in the game long enough to actually learn and become consistently profitable. The time of day you trade matters more than anyone admits. I spent years trying to trade all day long, thinking more screen time meant more opportunities. That's completely wrong. The market has personality changes throughout the day. The first hour after the market opens is chaos. Everyone is reacting to overnight news, institutional orders are hitting the market, and volatility is high. If you don't have a specific strategy for that environment, you're going to get chopped up. The middle of the day, roughly from 11 in the morning to 2 in the afternoon, tends to be choppy and directionless. Volume dries up, ranges tighten, and many of my best setups simply don't work during these hours. The last hour of trading brings another surge of activity, as institutions adjust positions and day traders close out trades. I now only trade during specific windows when my strategies have proven to work. This reduced my trading time by 70% and increased my profitability significantly. More trading does not equal more money. Better trading equals more money. Backtesting saved my career, but not in the way you might think. When people hear backtesting, they imagine running some automated system through years of data. That's not what I'm talking about. I'm talking about going back through charts manually and marking every single time your setup appeared, then tracking what happened next. Not just whether it worked or didn't work, but the nuances. Did it work better in uptrends versus downtrends? Did it work better on certain days of the week? Were there specific market conditions that made it more reliable? I spent 6 months doing this for just 3 setups. 3 simple patterns I wanted to master. By the end of that 6 months, I knew these setups better than I knew my own neighborhood. I could recognize them instantly. I knew their win rate, their average winner, their average loser, and most importantly, I knew when to avoid them. This gave me confidence. When I entered a trade, it wasn't hope. It was probability based on hundreds of examples I had studied. The news is noise. This took me an embarrassingly long time to understand. I used to have CNBC on all day, refreshing Twitter constantly, reading every market analysis article I could find. I thought being informed would give me an edge. It did the opposite. The news is designed to make you feel like you need to do something. Markets up? Here's why you should buy. Markets down? Here's why you should sell. Markets sideways? Here's the uncertainty you should be worried about. It creates an emotional response that makes you want to act. Trading on news is trading on everyone else's interpretation and reaction to that news by the time you hear about it. The information is already in the price. Now I check news only to be aware of major events like central bank meetings or earnings reports that might affect volatility. Otherwise, I focus entirely on price action and my setups. Price tells you everything you need to know. Price is the truth. Everything else is opinion. Losses are part of the business model. This is perhaps the hardest psychological shift for new traders. We're conditioned our entire lives to view losing as failure. In school, wrong answers lower your grade. In sports, losing means you weren't good enough. But in trading, losses are simply the cost of doing business. If you own a retail store, you have rent, utilities, and inventory costs. In trading, losses are your business expenses. The goal isn't to eliminate losses. That's impossible. The goal is to keep your losses small and consistent, while letting your winners be larger. I have months where I'm profitable on only 40% of my trades, but because my average winner is twice the size of my average loser, I'm still profitable overall. When I finally accepted that losses were inevitable and stopped seeing them as personal failures, my psychology improved dramatically. I could take a loss and immediately move on to the next trade without emotional baggage. Overtrading will destroy you faster than any other mistake. This was my biggest problem for years. I would have a good trading day, make some profit, and then keep trading to make even more. Or I would have a losing trade and immediately jump into another one to try to make the money back. Both situations are emotional trading, not systematic trading. I now have a maximum number of trades I'll take per day, regardless of whether I'm winning or losing. Usually it's between 2 and 4 trades. Once I hit that number, I'm done. Even if I see what looks like the setup of the century, I step away. This rule has saved me countless times from giving back a good day's profit or digging a deeper hole on a bad day. The market will be here tomorrow. There will always be another trade. Protecting your capital and your psychology is more important than catching every move. Stop losses are non-negotiable. I don't care how strong your conviction is on a trade. I don't care if you're sure the market is going to reverse. Every single trade needs a predetermined stop loss that you place the moment you enter the trade. Not a mental stop loss where you tell yourself you'll get out if it hits a certain price. An actual order in the system. Mental stop losses don't work because when the price is moving against you, your brain will rationalize reasons to give it more room. Maybe it's just a quick move that will reverse. Maybe your analysis was right and you just need to wait. These thoughts cost money. A physical stop loss removes emotion from the equation. The market hits your level, you're out automatically, and you move on to the next opportunity. My stop losses are always based on technical levels, not arbitrary dollar amounts. I find a logical point on the chart where if price reaches that level, my trade idea is simply wrong. That's where my stop goes. The concept of trading only what you see, not what you think, revolutionized my approach. I used to project my beliefs onto the market. I would think the economy was strong, so stocks should go up. Or I would think a company was overvalued, so it should go down. The market doesn't care about my thoughts. I now trade purely based on what price is actually doing. If my bias is bullish but price is breaking down, I trade the breakdown. If I think something is overvalued but it keeps making new highs, I can trade the uptrend or stay out. But I don't fight it. The market can remain irrational longer than you can remain solvent. This old saying is absolutely true. Trading your opinions versus trading reality is the difference between consistent losses and consistent profits. Simplicity beats complexity every single time. When I was struggling, my charts were covered in indicators, moving averages, RSI, MACD, Bollinger Bands, Fibonacci retracements, volume profiles, you name it. I thought the more tools I had, the better my analysis would be. But each indicator is just showing you price in a different mathematical formula. They're all lagging because they're based on past price action. I slowly stripped everything away until my charts now have price, volume, and a couple moving averages for reference. That's it. My trading decisions are based on price structure, support and resistance, and basic supply and demand. These concepts have worked for 100 years, and will work for another 100 years. The fancy indicators, the complex algorithms, the AI prediction tools, they're not giving retail traders an edge. They're giving you more things to be confused about. Journaling is the most underrated tool in trading. Not just tracking your trades, but actually writing about what you were thinking and feeling during each trade. Why you entered, what you were expecting, how you felt while in the trade, why you exited. When you review your journal, patterns emerge. You start to notice that you always give back profits on Friday afternoons, or that you trade poorly after looking at social media, or that your best trades happen when you wait for specific confirmations. These insights are gold because they're specific to you and your psychology. I review my journal every weekend. I look at both my winning and losing trades. The losers show me what to avoid. The winners show me what to repeat. This feedback loop compounds over time. Small improvements each week add up to massive improvements over months and years. The concept of probability versus certainty separates professionals from amateurs. Amateurs look for certainty. They want to know this trade will work before they enter. Professionals understand probability. They know that if they take this same setup 100 times, they'll profit overall even though individual trades might lose. This mindset shift allows you to take trades without fear. You're not hoping this specific trade works. You're executing your process knowing that over a sample size of many trades, you'll be profitable. Think about casinos. They don't know if the next person at the blackjack table will win or lose. They don't care. They know that over thousands of hands, the math is in their favor. That's how you need to think about trading. Each trade is just one hand in a long game. Your environment shapes your trading more than you realize. I used to trade from my couch with the TV on, my phone next to me, and my laptop balanced on my knee. I wondered why I kept making impulsive decisions. Your trading environment should be free from distractions. A dedicated space where you only trade, not watch Netflix or scroll social media. My desk now faces a blank wall. My phone is in another room during trading hours. I have a checklist next to my monitor that I review before every trade. This physical environment creates a mental state that's conducive to disciplined decision-making. When you sit down in your trading space, your brain knows it's time to be focused and systematic. Mentorship matters, but not in the way the industry sells it. You don't need to pay thousands of dollars for some guru's course. Most of what you need to learn is available for free. What you need is someone who's actually profitable and willing to be honest about the struggle. Someone who will tell you that trading is hard, that you'll lose money while learning, that most days are boring, and that there's no secret formula. I found this through trading communities online where people share their actual trades, losses included, and discuss what's working and what isn't. Avoid anyone promising guaranteed returns or claiming they never lose. Those people are either lying or selling something. The transition from demo trading to real money is where most people fail. Everything changes when real money is on the line. You can be perfect on a demo account and completely fall apart when it's your actual savings at risk. The fear and greed become real. The solution isn't to avoid this transition, it's to manage it. Start with the smallest position sizes your broker allows. Trade real money but in amounts that don't trigger emotional responses. You need to learn how your psychology changes when real dollars are at stake. But you need to do this in a way that won't blow up your account. Gradually increase your position sizes as you prove to yourself that you can execute your system with real money the same way you did on demo. Time frame matters immensely for your personality and lifestyle. I started as a day trader because that's what I saw everyone talking about. I would sit in front of my computer for 8 hours trying to catch every small move. It was exhausting and unprofitable. I eventually discovered that I trade much better on longer time frames. I now primarily trade off 4-hour and daily charts. My trades last anywhere from a few days to a few weeks. This style fits my personality. I'm not wired to make rapid-fire decisions. I like to analyze, plan, and let things develop. Some people are the opposite. They love the action of short-term trading and would be bored with my approach. Neither is right or wrong. You need to find what aligns with your personality and schedule. Fighting against your natural tendencies is a losing battle. The compound effect of consistency is staggering. If you can average just 2% profit per month consistently, you'll double your account in 3 years. That sounds slow compared to the people online claiming they tripled their account last month. But those people usually blow up eventually. Slow, boring, consistent growth is how real wealth is built in trading. I stopped chasing home runs and started focusing on singles and doubles. Instead of trying to make 20% in a month, I aim for 2 to 4%. Some months I exceed that, some months I don't hit it. But over a year, the consistency adds up. More importantly, trading for consistent small gains keeps you psychologically balanced. You're not on an emotional roller coaster of massive wins, followed by devastating losses. After 20,000 hours, the biggest truth I've learned is this. Trading is simple, but not easy. The concepts that actually work are straightforward. Trade with the trend. Use proper position sizing. Cut losses quickly. Let winners run. Be patient. Follow your system. None of that is complicated. But executing these simple principles consistently when money is at stake, when you're on a losing streak, when everyone else is panicking or celebrating, that's the hard part. That's why most people fail. They're looking for complexity because surely something this lucrative must be complicated. It's not. It's simple rules executed with discipline over a very long time. If you can accept that trading is boring, that most days you won't trade at all, that profits come slowly, and that losses are guaranteed along the way, you have a chance. If you're looking for excitement, for quick money, for certainty, you'll lose. The market is the greatest teacher you'll ever have, but the tuition is expensive. Save yourself some of that cost by learning what actually matters. Focus on risk management, above all else. Master a few simple setups rather than learning everything. Trade small and trade consistently. Keep a journal and review it religiously. And remember that this is a marathon, not a sprint. The goal isn't to get rich next month. The goal is to still be trading and profitable 5 years from now.